Hey guys, today we're going to be talking about Capital IQ and how we can use it to build a DCF to value a company using the Excel plugin that Capital IQ has provided us on the Mill Workshop. So first of all, on your desktop, make sure you have open the Excel sheet that's provided named CIQ DCF with the student model. You'll have an answer key, which I have open here, and a regular blank template, which we'll create in a second. You can also pull it directly from the desktop. And also you have a PDF with the PowerPoint that will have all the information that you need in case you need to reference it back or if there's something that you missed. So first of all, we're going to talk about valuation, how valuation works, go through discounted cash flow, projected free cash flow, talk about weighted average cost of capital. I'm sure a lot of you guys have learned this in Fin 221, but we can just cover it as review one more time. The concept of terminal value in a DCF, and finally the model itself, and we'll see how that's built out and how it works later on. So let's go ahead and tab out first. I personally don't have this blank template on my desktop, so I'm just going to delete all these items first. Actually, let's create a blank template like so. I'm just going to go ahead and delete these numbers. Let's delete these. All right, so on the Excel, we now have a blank template and just a quick walkthrough of what's going to happen. So these items up here are going to be pulled using formulas across this entire area as information, and Capital IQ is going to pull revenue for you. It's going to give you the gross profit and EBITDA, and the goal is that every time you change the ticker up here or the name of the ticker of the company, the entire model will update and spit out how much they expect each of your shares or how much your entire company is going to be valued basically. And the dates here are dates that you put in. If you put in the current date, it's going to value this company based on the most recent fiscal year. So first, you'll notice that we're pulling financials from 2016, 2017, and 2018. These are historical financials like you can see up here. When we pull these in, we're going to use these to calculate metrics that are eventually going to calculate the rest of your expected cash flows. So over here, based off these numbers up here, we're going to calculate these metrics down here. We're going to use an average of these metrics to calculate these. And with these numbers, we're now going to calculate up here, which is going to give us the cash flows of the company year over year. And if we know how much cash flows the company will generate every year, you can kind of guess how much the company is worth. Obviously, you want to back check it with different types of valuation methods. In our other classes, in our valuation bootcamp, for example, we talk about how to use comparable companies, whether it's public or private, using an LBO or any other method. You can kind of take an average or use your rationale to try and figure out which valuation method you want to weigh most heavily towards. So let's talk about valuation then, right? So there is a concept of equity value and enterprise value. So an enterprise value is the value of the assets that are attributable to every single stakeholder in the company, right? So not only the people who own shares within the company, also the enterprise value is also attributed to the creditors, people who have loaned the company money. The equity value, on the other hand, is the value of the company's core business assets that after it pays off its other obligations, so after it pays off other items that are attributed more to creditors. So value measurements that we use for equity value as free cash flow is net income. Maybe we use EPS sometimes, book value sometimes, and for enterprise value, you might be using EBITDA, discounted back EBIT, or free cash flow. As you guys all know from Fin 321, or if you're a freshman or sophomore, what you guys will find out is that enterprise value is comprised of equity value, and then you're adding back debt, right? Because when you buy the company, so a concept that you need to know first is the enterprise value is what a company can expect to pay when they buy a company, right? So you're not only buying out the shares of the target company's equity value, you're also paying their debt obligations, their preferred stock, their minority interest, and you're subtracting out cash because when you buy the company, you're able to take that cash and pay off its debt. So plus debt minus cash plus preferred stock plus minority interest. There's some other items that you may need to add or subtract, like unfunded pension obligations or warranties, but for now, we're not going to worry about that. Some of the items that we talk about in our valuation bootcamp series is that there are 3 primary valuation methodologies. There's the comparable companies, precedent transactions, and discounted cash flow. The first 2 are what you consider relative valuation methods. So those methods value metrics relative to their companies, and then you use what we call multiples to apply then a valuation to your current company. So for example, if another company is worth $100 million and they generate $10 billion or $10 million of EBITDA, then you would say they have a 10x multiple. And if your company has a 5x EBITDA, then you would take that 5 times the 10, which would give you a $50 million valuation. Discounted cash flow values a company based on how much cash we can expect the company to generate into the future, right? So, for example, if I told you that that if you bought a nickel machine and it gave you a nickel every year, how much would you pay for that, right? That's basically what the discounted cash flow does. How much is all that money in the future worth to you now? If you were to buy it, that's how much you would pay. Some other valuation methods that are quite common are the LBO, or the leveraged buyout model. And this creates a floor for the valuation. So usually valuations don't go much lower than an LBO. The precedent transactions tends to give a pretty high valuation. So does the DCF. The comparable companies fall somewhere in the middle. Accretion dilution model basically calculates whether or not a company's earnings are going to be accretive or dilutive, if their EPS is going to go up or down after they buy or merge with another company. And at the bottom, just a note to make, right? The numbers that we pump into this model, these models are only as good as your rationale, right? So if you have horrible numbers and your representation of free cash flows is not very accurate, the valuation of your company is not going to be accurate as well. Similarly, if you use the wrong comparable companies, you're not truly finding the right valuation for your company, right? So trash in, trash out first and foremost. And also between the different valuation methods, you have to see what you value more as an investor or as a company that's buying another company. And as a result, we also complete this thing called a sensitivity analysis, which we'll see at the bottom of the Excel sheet right here, where if the multiples were to change, an exit multiple is the multiple that we sell the company at, and we'll explain more what this is at the end of our exit, and the WACC, which is basically our discount factor, our opportunity cost for taking on this money, right? So if I borrow to a company with a WACC of 5.3%, I would expect, or if I had a WACC of 5.3%, then I would, as an investor coming in to lend the company money, we'd on average probably expect 5.3% between equity and debt, right? So they'd probably pay me back $1.05 or something like that. The valuation in the middle is what we expect to be closest to the price, and then outside, obviously these are the sensitized values. This is more likely, and then this is probably the least likely. All right, the discounted cash flow. So what the discounted cash flow is, I'll keep this brief because I'm sure most of you guys know what this is already, is that it takes the present value of the cash flows that goes into the future, right? So once again, if you were to buy a nickel machine and that nickel machine gave you a nickel every single year, it takes how much you believe that nickel machine is worth to you now. If that nickel machine spit out a nickel every single year, how much is that worth to you now? And that's basically what the value we capture with the discounted cash flow is. Okay, the rest of the stuff you guys probably mostly know, but some note to make about the discounted cash flow is that, first of all, if you put in horrible inputs and assumptions that project into the future, you're not going to calculate a very consistent and accurate cash flow projection. And also, if you're using management projections, those tend to be very lofty, right? If you're running a company, you tend to believe that your company is going to do very, very well. And so the projections that you give the financial community are also going to be very, very buffed, basically, right? So discounted cash flow tends to spit out a pretty high valuation, especially if you use management projections. So just keep that in mind when you're weighing between the different valuations. now we're talking about projecting free cash flow. So free cash flow is basically just how much cash is the company generating at its core, right? To pay not only its creditors, but also its equity investors, right? Because if you use unlevered free cash flow within a DCF, it will spit out the enterprise value. If you use something called a levered free cash flow, you're spitting out equity value, right? Because levered free cash flow, you already paid off your interest and your mandatory debt repayments. And so when you do a DCF with that, you're calculating what's left for equity investors. So, okay, so just a few more concepts, right? Weighted average cost of capital is basically, it's just a weighted average of how much it costs you to fund $1 of debt, how much it costs you to fund $1 of equity, or to borrow $1 of equity from the capital markets. And using the proportions that you have for the amount of equity and the amount of debt you have within your company, it spits out a number that's going to approximate how much it costs you to raise $1 in the capital markets, whether it's debt or equity. Quite simple concept, right? We're going to use this WACC as an approximation for the opportunity cost that it takes for you to pursue other projects. So, for example, if we get $1 every year, we're going to use that, for example, 5% rate that we get from the weighted average cost of capital to say, if I want $1 as opposed to $1 today, $1 tomorrow as opposed to today, then I'm going to need 5 cents extra with 5%, basically. All right, so let's just go ahead and get started for now. We have up to the terminal value calculation, but we have all this other stuff to get done. One note to make about this Excel sheet is that in the beginning, when you first populate the sheet, and there are a lot of pound value errors around, make sure you go to the top of this ribbon, you click S&P CapIQ, and then click on the refresh drop-down menu and make sure you click refresh workbook. And what this does is basically goes to CapIQ servers and says, I think the numbers we have here are out of date. Let's go ahead and refresh them. And the numbers should populate quite nicely. If you're having an issue, you can contact people at the middle desk and they'll tell you how to fix it. So first, let's go ahead and pull revenues and the gross profit. So, let me pull up a answer sheet and I'll be right back in a second. So we're back. We have the answer sheet opened right here, and we're just alt-tabbing between the different tabs, like so, to make sure that we're getting the exact same consistent answer. So first, we're going to pull these numbers like we talked about before. So we're going to use the CapIQ plugin. You're going to use something called the formula builder up here on the ribbon. So make sure you go to the top, S&P CapIQ, the formula builder. Also, make sure you have your selector, this green box over here, on the first year in the revenues line. So basically, whenever you build a formula, that's going to be the starting baseline for the different formulas that you make from the formula builder. So as we mentioned in the Excel class, we're going to press Alt first. We're going to try to use the keyboard as much as possible. S&P CapIQ ribbon is C, and formula builder is FB. So in sequence, if I did that again, it's Alt C FB, not holding down the F. Not holding down the Alt key, we're just pressing them sequentially. And in this window, we have the formula builder. Very simple. At the very top, this line talks about what company you want to pull. Usually you want to put the ticker of the company, which is basically the shortened version of their name that they use to trade on a major exchange, right? The ticker up here, the item you're trying to pull, right? So you notice that our selector used to start off at revenues. So we're looking for revenues here. And then the period somewhere over here is which year are you pulling for, right? It was 2017, 2016, so on and so forth. At the bottom, once we're done adding a formula, it's going to stack down here, so you can add multiple formulas at the same time, but we'll talk about that in a little bit. So first of all, the formula builder, we mentioned that we want to make the model so that if we change the ticker up here on the Excel sheet, it'll always pull different numbers. So we're going to click on the cell, and this is because we wanted to reference this cell every time to figure out what company it's going to make, or what company it's going to pull for, right? So we're going to click on cell, click in this box right here, the first one, and click on cell E3. cell E3, right? And then we're also going to press F4, and I'll explain in a little bit. The data item keyword that we want is revenue in this case. Don't do total revenue, make sure you do revenues, just because these also include sales before coupons and discounts and things like that. And so make sure you use IQ revenue, the second one over here. And for the period, you also want it to reference the dates in case we change the dates up here in bold over here. So you're going to click on the cell once again and make sure it references fiscal year 2016 and 2017, or 2016 right here, so cell D12. Once you're done with that, click Add Formula. And if I clicked OK right now, then the formula would pop up where my selector was when I first opened the formula builder. What you want to do next is you want to make sure that you can add multiple different formulas. So instead of adding formulas across the row, if I added, for example, 3 different formulas in this box, it would first go 1, 2, and then 3. So 1, 2, 3. If you do down a column, our selector started here, it would do 1, 2, and then 3. Right? So if I add another formula here, gross profit, then I click add formula. Everything else is the same, right? We're using the same company, same period, add formula. Gross profit would now stack downwards because of the formula layout being down a column. So it would now go here, right? Gross profit, EBITDA, add formula. Let's do operating income. Depreciation first. Add formula. So you're just changing this item up here and then adding the formula. And then operating income we don't need because you can calculate the operating income using EBITDA and depreciation. EBITDA, remember, is earnings before interest, taxes, depreciation, and amortization. If you subtract out depreciation and amortization, it leaves EBIT, which is operating income. So now if I click add formula, or click OK, you'll notice that they all populated downwards. Operating income, once again, is just EBITDA minus D&A. And then I'm just going to Alt-Tab to make sure we got the same numbers, and we do, so we're good. With the rest of these things, we're just going to copy across the formula to the right. So what I did was I highlighted the entire area that I wanted to copy to the right, and I held Control and pressed R, and that copies the formula to the right. The reason I used the F4 button earlier when I had locked in Verizon is that with the $signs, if I copy the formula to the right, the $signs make it so that the cell reference doesn't move when I copy the formula to the right also. So without the $sign, if I was calculating 2017, because I copied this formula to this column, it would also now look at the next column over, and there would be no item there. So we still wanted to look at cell E3, which is why we did the F4. If I Alt-Tab, we have the same numbers in the green area. So we're good. Capital expenditures. So we're going to have to go ahead and pull these for some of these calculations. But first of all, sales growth. I believe these are already filled in for you. So I'm just going to copy in the formula over here. If it says margin at the end, it just takes the item and it divides it by revenue. So just be aware of that. Let's go ahead and copy this in. Okay, well, we're going to have to calculate this manually. Just current year divided by last year minus 1. Gross margin is gross profit divided by revenue. I'm assuming everybody knows these items. So we're always going to divide by revenue. So let's lock it in 13. And then these aren't in line. This one's not in line. CapEx is not in line. it should be using this line down here. So what we're going to do, I believe you guys already have these numbers, so we're just going to use CapIQ once again. So Alt-CFB. I'm going to pull this really quick because I think you guys, once again, already have it. Yep. Take capital expenditures and divide it by revenue up here. And so if you guys were lost at any point there, these are the formulas that we used to calculate this purple area right here. You can go ahead and pause the video if you were lost or if you accidentally deleted that in the beginning like I did. All right. Next up, in order to calculate the operating figures over here, we're going to first take these ugly pinkish lines and we're going to use CapIQ estimates just because analysts tend to be better at estimating these important items than we are using this average method. So we're just going to use the estimates given on CapIQ. And how you're going to do that is you're going to use the formula builder once again. So Alt-CFB. You're going to go on to estimates. So before you would just type it directly in here, but what this does is it searches the rest of the stuff in these tabs in the folders. So we're going to go to the estimates folder, click on CIQ estimates, consensus. See if we can find revenue here. Let's just use revenue. Revenue right there. We're looking at Verizon. The item is already filled for us, and the period is looking at cell 2019. We're going to add it twice so that we skip this line. The next formula will be this line here. Let's add EBITDA. Okay. We're good with the numbers. Just copy these two formulas to the right using Control R. Now, these two purple lines we can calculate using these historical numbers, right? These are just probably averages of the last few numbers that we've used before. So gross profit using our historical metrics is equal to revenues times gross margin. Using Control R up here, depreciation margin times revenue is going to give you depreciation. The taxes are equivalent to the expected tax rate times your operating income. And your operating income minus your taxes is going to be your affected tax EBIT. Your tax affected EBIT is just up here, so you're going to set it to equal that. Depreciation, you already calculated up here. Change in working capital, you're going to pull from the previous tab. So we've already done a sheet for you where you calculate all of these numbers. If you're interested, you can use F2 to look at how those are calculated exactly. But your change in working capital, you'll see that in 2018 you had 7,743, and it goes to 6,693. So you should be getting an inflow of cash, right? So you know in finance that or accounting that when your working capital goes down, you get a cash as a result, and you see that they subtracted it as so that you get a cash inflow because it went down. So your change in working capital is just going to be this number right here. It's cash inflow. So, yep. Change in working capital, just making sure. Right, so in the answer key, I believe they mistakenly made the change in working capital negative, when in fact, because the working capital went down, you should be getting positive cash flow as a result, right? So there's no need to subtract it. You'd effectively, the way they set it up, you'd be making it negative twice. So don't go through with that. With the CapEx margin, we're going to take the historical numbers and we're going to take the CapEx margin times the revenue and slap a negative on top so that, because CapEx is a cash outflow, right? So you're losing money as a result. And this is all it is. You just sum all of them together. Tax affected EBIT plus D&A minus CapEx minus changes in net working capital. 13,758. There's a difference. 22,829. So I believe I made a mistake here. So I did it with a depreciation number. Really, you should be tax affecting like we did over here, the operating income. So let's go ahead and take the revenues multiplied by, the EBITDA minus the D&A. Gives you 30,439. And then you're tax affecting the operating income down here instead. So 7610. You're losing money for that. So you should get 9,000, 22,000. There you go. So, and depreciation, we formally use the depreciation number. Make sure you use the operating income number, and make sure you slow down if you're making mistakes as much as I am. But like so, with the 1050 difference between the answer key, the rest of the numbers are correct. Just copying the exact same formula over. This didn't work because, as you noticed, the reference is dragged over also. So we're going to lock in the 25% cell so that when we copy it, it always stays there. The discount factor is merely just a tool to calculate the cash flows. You're just going to do equal 1 divided by, equals equal to 1 divided by 1 plus the discount rate right here. And we're going to lock the discount rate in to get the discount factor all the time. And also make sure you're adjusting for the number of periods. So this is only period 1. As you go further, it discounts even more, right? Further into the time. From there, you multiply the unlevered free cash flows with the discount factor, and that gives you the present value of your cash flows right now. And the rest of this, they add all these cash flows, they calculate something called the terminal value, right? So let's talk about that concept real quick. The terminal value is basically the value of the calculation, this is basically the value of the cash flows beyond the period that you projected, right? So in this model, we only calculated 5 years of cash flows. Beyond that, all of the cash flows are slammed into one value called the terminal value. The value beyond that is, the value of the company beyond the projected cash flows are the terminal value. So we calculate that using the WACC, the terminal multiple, which is usually taken from the comps, and you use the terminal year EBITDA, you multiply it with the number that you get from the comps. Either you get a terminal value like that, and you discount that back from period 6 all the way back to present value, or you use the perpetuity method where you calculate using the last year's free cash flows multiplied by 1 plus the growth rate into perpetuity divided by the WACC minus the growth rate, right? You learned that in finance, in Fin 221, I believe. From there, you add the terminal value plus the unlevered free cash flows, and that spits out a valuation with the valuation of the shares, right? And you'll notice that if I change this to another company like Tesla, for example, It doesn't have too much information. Let's do, right? It spits out a valuation here as well. This is going to be a little off because this is a very simplistic model, but in general, it does a pretty good job. Okay, so now that we're done with that part, okay, we can skip over this stuff we've already talked about. Okay, so let's talk about WACC a little bit more in depth, because obviously when you change the discount rate, the present value of your cash flow is going to change quite drastically. So the way the WACC is calculated is through this sheet right here. So the competitors for Verizon, as CapIQ says, are AT&T, Comcast, Sprint, Altus, Cogent Communications, and CenturyLink. And they take basic metrics like the amount of debt they have as opposed to their market cap, and they calculate a percentage. And with that, they calculate the unlevered beta, so basically the risk of the company on the market compared to the indices it's trading at. And then from there, with the cost of debt that they have and the cost of equity, they use the CapM model and the after-tax cost of debt to calculate the weighted average cost of capital. So let's go ahead and pull those numbers. This is a relatively easy exercise. So market cap here seems to be a little broken. IQ 147. Sprint's market cap is not pulling properly. Sprint Corporation. Okay, let's not worry about that for now. So let's go ahead and pull these. Let's delete all the green numbers and redo them just to show you guys. So total debt and market cap, right, are the items that we're pulling on CapIQ. So Alt CFB to get the formula builder. The cell we're looking at is Verizon. Locking that in. Data item keyword, total debt. And if you leave this empty, it will pull the most recent number that it has. So market cap, those share prices change day to day, so it's going to change. Total debt probably is just going to take the most recent number from its releases, right? So we're not going to put a date. Add formula. We're total debt. We want to do market cap now. So market cap. Add formula. Click OK. So with this, we're going to use most recent. I understand that there's also a date up here. If you want to use the date using the cell reference, you can also use this date to calculate a different WACC. So let's go ahead and copy these down. So using these, we're going to do Control C for these and paste special the formulas so we don't ruin the colorful borders. We're going to paste special in the formulas using Alt ESF. Delete these numbers. So actually, no, this is just for Verizon. Let's go ahead and move these to reference the tickers on the left right here. So instead of cell D3 up here, let's go ahead and reference column B, locking in, no need to lock in anything. Also column B over here. Let's take out the lock. Pressing F4 3 times. Let's copy these down using Alt ESF again. Now we're pulling the debt and market cap of our competitors, like so. Let's go ahead and calculate this. So unlevered beta equals G10 right here. AT&T's levered beta, we're going to unlever it so that they're all comparable, and then we're going to lever it to the company we're valuing, which is Verizon. So G10 divided by 1 plus 1 minus the tax rate times the debt to equity ratio, 0.52, and we're going to use it for the 1-year beta, and then we're also going to unlever the 2-year beta. All right, so this can all be copied down. The same exact things for the 2-year, levered beta divided by 1 plus 1 minus the tax rate times the debt to equity ratio, all DSF. And there's a div 0 because the market cap is not pulling properly here. So we can go ahead and just slide in an if error. If error. You know what, let's just delete these for now for demonstration purposes. It's going to take the average of these, and then it's going to use that to calculate what a basic risk is within this industry. The comp set beta is an issue with this, with the average. So if we delete that, if we delete all of Sprint Corp stuff, just because the market cap's not pulling properly, you'll notice that this sheet takes the comp set beta, which is the median of the unlevered betas with the company. It's going to relever it, right? You can pull this also from Bloomberg. And you're going to use that beta to calculate the cost of equity using CapM with the risk-free rate, the beta, the risk premium that you insert. You can find this on Bloomberg for the type of company, and the cost of that, which gives you the cost of equity, and the cost of debt after you affect the using the risk-free rate and using general information available, tax affect that, and you get the cost of debt also here as well. So from there, with the amount of debt that you have within the company and the amount of equity that you have with your market cap, it weights it, and it takes the cost from the after-tax cost of equity and the cost of, the cost of equity and the after-tax cost of debt to give you the weighted average cost of capital. So using that, that's pulled into your DCF, and that's going to be what calculates your discount rate. So that's it for the DCF. Today we talked about pulling information directly from CapIQ, using those metrics to calculate future cash flow projections, and then from there using an intrinsic valuation, which is this DCF, to calculate an estimated price per share of this company and the value of the company overall and its enterprise value. We talked about the weighted average cost of capital, how that's calculated using its competitors, and also using CapIQ to calculate some of the basic figures which are needed to get your unlevered beta, and then which is then used to calculate your weighted average cost of capital with your cost of equity and your after-tax cost of debt. So overall, that's it for the DCF. It's quite easy. If you have any questions, feel free to ask the front desk at the Market Information Lab. Thank you so much for your time. Hope everything goes well.